It turns out that the dollar borrowing or the dollar equivalent borrowing market against crypto as collateral is enormous. We think it's above 100 billion. People think that the traditional markets world or TradFi and crypto are distinct. I would argue they're not, they're one and the same. Your business allows asset managers, smaller ones or larger ones, to be able to democratize the subscription in kind or in straight fiat to their business in this jurisdiction and to gain regulatory clarity on an accelerated basis.
This is the Assetizer Podcast.
Hello, everybody, and welcome. My name is Tom Lyons. This is the Assetizer Podcast, and today I'm sitting with David Arnold.
Good afternoon.
Who has quite the background in traditional and decentralized finance. So we're going to get into all of that. We're going to talk about crypto. We're going to talk about crypto lending. We're going to talk about innovative asset management projects and products with GenTwo, among others, and a whole bunch of fun stuff. So, David, welcome to the show.
Thank you. Thanks, Tom.
So, David, as I usually do on these shows, as most people do, would like to talk a little bit about yourself, your background,
Of course.
and kind of the trajectory that brought you here today.
Perfect. Couldn't be any more traditional in the sense of, the milk round going out of university in the United Kingdom. I was an equity analyst, sat in prop trading for a period of time, adjacent pieces of investment banking across the industrial space, automotive, capital goods, aerospace and defense, on the sell side predominantly. And then 2019, post-MiFID II, exited TradFi to a certain extent, joined BTIG, which is a spin-off of Goldman's, but joined their digital assets team when they were raising a lot of money for essentially the sort of picks and shovels in crypto. The miners, what are now the prime brokers, the likes of Falcon X, some of the exchanges, including FTX. So, interesting history there.
Had you already been in digital assets and crypto? This come out of left field a bit.
I guess two different pieces. One, as a retail investor, yes. Two, my wife led the way. She actually joined a firm called Copper.
Oh, sure.
Yeah. So, quasi-custodian, off-exchange settlement provider, etc. She's very close friends with the founders, specifically Dimitri. Sen Kostadinov and I used to work together at Barclays Capital. And then, frankly speaking, the route for me wasn't actually as a Bitcoin maximalist or as a blockchain maximalist. If you look at what happened to the auto companies, certainly Volkswagen post-Dieselgate, bit of a tangent here, but if you bear with me,
Sure.
the blockchain solution for being able to prove out the sourcing of all of the supply chains that underpin people like Volkswagen, for example, and their solutions around how they met the post-Dieselgate furore from a regulatory standpoint, that was done and is being done in blockchain. But once you go down that pathway, it becomes almost natural that you then start pulling at the thread of 24/7 trading, T+0 settlement in terms of, again, for traditional market trading. And then, of course, you go down the stablecoin route and everything else sort of starts to ratchet from there. From BTIG, I joined Hidden Road right at the beginning of their digital assets journey. Mark Ash is a very, very close friend of mine, deeply impressive individual. Again, TradFi. Mike Higgins, the guy who actually runs it out of London, from a digital asset and traditional markets perspective for Hidden Road. They've built an amazing prime broker. But would that market opportunity really have happened if digital assets hadn't been calling? I don't know. We'll never know what that pathway would have been, but they've obviously now been acquired by Ripple as a multiple different jurisdiction regulated interface for counterparties not willing to face crypto exchanges because of the regulatory risk, if you will, post-FTX. And also, frankly, because regulated investors, public investors, can't necessarily face an unregulated asset class on unregulated exchanges. Now, that pathway is changing as we go through sort of the journey for crypto trading and potentially also for tokenized real-world asset trading as that starts to evolve and emerge. So I guess the pathway for that is evolving, but it's here to stay. And I guess that's kind of where the next part of my journey has come in terms of, right, so you've got this 24/7 T+0 asset class, if you will, from a settlement and from a trading perspective. Massive liquidity. But how do I face these markets in a regulated manner? Do I do it through facing an intermediary, like a Hidden Road, a Falcon X, and their peers? Or do I do it in a jurisdiction which recognizes the asset class? And that's kind of how I've ended up being in Switzerland, and why myself and my partners are actually building a business here.
Okay. There's so many things to unpack there, to be honest.
Yeah, of course.
One thing I have to bring up, because I've been having this conversation also with Mark Arasarotnam, head of GenTwo Digital, who was just here, and others. So I've been in this space since 2016, right? And I know that there's blockchain people and there's crypto people, and sometimes there's a mix. I came more on the blockchain side, right? But one pulls the other.
Yes, it does.
Right. And
Absolutely.
in your case, it's interesting. So you came fascinated by the blockchain, I guess, and into that, and then discovered the digital assets. Often it's the other way around.
Yeah.
Okay. So one question, this is also a tangent, you have to excuse me. Do you think that the current crypto moment with digital assets now really mainstreaming, perhaps this time's different, we'll have to see. Is that going to pull adoption of blockchain for non-currency use cases, for the supply chains, for the health cares, for all the other stuff that blockchain is known for?
It ought to. One probably doesn't trigger the other, apart from the use cases around stablecoin and how that impacts settlement cycles for real-world industrial applications.
Yeah.
So I think that, if you look at what some of the big patent holders, for example, in healthcare, the ability to share information and to be able to do so in a seamless manner is already being used by some of the big, for example, charitable foundations that fund research into opaque areas of medical research, biotech, etc.
A token can represent money of some kind, or it can represent a data record.
Absolutely.
It's just a token.
Yeah. NFT slightly has a bad, should we say, image.
Right.
After the furore during the COVID era, so 2020, 2021, and the idea of Web3 and, I've got to buy this piece of real estate in the metaverse.
Mm-hmm.
I
don't know what happened to the metaverse, but that's another.
That's another discussion. The Tetris world perhaps didn't catch on in the way that maybe people thought it was going to.
Yeah.
So, but it doesn't mean that it wasn't a good application, perhaps at the wrong time and without the right follow-up. So, for example, the same thing I think applies right now with tokenization of real-world assets. It's a great idea, but you can't create a secondary market for something without there being liquidity.
Yes.
And that is kind of what I think is being answered. And I think kind of it's the genesis of your question, or the evolution of the answer to that question is actually, right, where does the liquidity come from? And as people, or as large market participants, start to use digital assets in the broad, whether it be stablecoin or, for example, Bitcoin, as a means to store value in terms of treasury assets.
Yeah.
And or invest in things, and to do so in a seamless manner cross-border. I don't know I don't know which is the chicken and which is the egg. But for example, capital controls, which are still in existence in various Latin American countries, coupled together with perhaps some of the concerns that people have over G7 currencies, inflationary pressures. People are talking openly about capital controls being brought back in the United Kingdom. Now, that would be a major shock to the financial system. And that will likely spur on the use case in real-world examples, not only for tokenization of real-world assets, in order that we can see seamless cross-border transactions happen, but also in order to meet, on the flip side, the use of stablecoin as a means of exchange.
Right.
So I don't know which is chicken, which is egg, but do we really need to know? There is the chicken, and therefore there had to be the egg. So
Exactly.
it just does this.
Yeah. No, 'cause I always ask this question because I worked for a long time on various adoption projects,
Yep.
and it's just always been a push, but you see it slowly but surely, and I think the currencies, the tokenization always leads the way.
Yeah, absolutely. As STX has proved.
Yeah.
I mean, great business. In theory, Switzerland, unlike virtually all of the developed world economies, has 2 CSDs underneath the national sort of schema for settlement and custody. One of them is unused. One of them is designed to be used in a digital asset world. The Swiss have built out Project Helvetica, and namely a central bank digital currency, which is not a representation of Swiss franc. It is
one.
Swiss franc, exactly. So the fact is that maybe they were 5 years too early, but it doesn't mean they weren't right.
Okay. Well, I mean, that brings us back to your
course.
story, because now you're you got into digital assets, decided to stay. You come to Switzerland.
Yes. 2 years ago.
Is it 2 years ago? So what do you like about the place? I mean, obviously the regulations, but let's get into that.
Where to start? Starting with the pull, you've got a very stable jurisdiction from a regulatory standpoint. The post-2021, the Swiss government, in whether it be FINMA, the SNB, or otherwise, or a coalescing of those different interested parties, decided to essentially expand the umbrella of securities regulation, and including custody.
Like DLC.
Yeah, exactly. But that umbrella now includes crypto. It's a bona fide asset class. It's a regulated asset class here. There's no question mark over it. Now, we can go down the rabbit hole of what is a security token, what is the other types of assets that sit underneath that nomenclature of digital asset. But in reality, that doesn't matter. It is enshrined in Swiss code. So, for example, if I hold Bitcoin, or indeed stablecoin, with a regulated institution, and by that I mean a custodial entity, bank, pure play custodial entity, or even the entities such as Copper, for example, that are somewhere between the two, and with temporary licensing. If I hold one of those assets with an institution such as that, if for whatever reason, unfortunate reason, as we saw with the insolvency of Flowbank in May last year in Geneva, assets held by that institution are bankruptcy remote. In the same way that if I hold a Daimler share with a Swiss custodian, that custody is probably devolved back to Six Group because of the unique nature of the way in which the Swiss banking system works, but it's bankruptcy remote, it's client segregated. I have my asset back, so I don't have counterparty credit risk in the same way that I do in other jurisdictions. I don't have to fight it out in the insolvency court. It's cut and dried, and it takes days to get my asset back, not years, as we've seen from some of the insolvencies, albeit more complicated, such as FTX and other Genesis BlockFi scenarios. But bottom line is, it's an asset which is enshrined in regulatory code post-2021. It just so happens that my business partner actually co-authored the code when he was at FINMA, Marcel Hostetler.
Okay.
So, and he sits on the regulatory board of Six Group. He's obviously chief external counsel at SDX and Copper and various other people. That actually is all not by design, but by accident. It just so happens that it's a very small community here.
That's for sure.
Which is a good thing and a bad thing.
Mm-hmm.
It's a good thing if you have a good market reputation. It's a bad thing if the inverse is the case.
Okay.
But more importantly, I think from a point of view of building a business such as the one you guys have built, an enviable market reputation and frankly dominant in that space, you can have a sensible conversation with the regulator. It's not this amorphous mass with constantly changing individuals like the FCA, and the amazing legal team at Hidden Road certainly face these challenges with the FCA and with the CFTC and the SEC and every other regional jurisdiction from a regulatory perspective. Here, you can have a sensible conversation with FINMA and with the devolved entities that govern different bits of lending against assets, securities trading. Whoever the relevant party is, whether it be Six Group acting on behalf of FINMA, or BX acting on behalf of FINMA regarding lending, and we can come on to that later if that's appropriate. But you can have a sensible conversation. You can have a sensible conversation on taxation. Capital gains taxes, of course, are not a prevalent thing here.
Yeah.
Wealth taxes are. So for different individuals and for different institutions, there is, I wouldn't say loopholes, but an accommodation which allows business to flourish here. And that is important.
Okay, so I want to bring the conversation obviously to around to GenTwo, but before that, let's fill in the gaps when you get to Switzerland and the projects and the companies you've been involved in there, because that leads up to where we are today.
Of course. Where do we start? Let's start with why. So Hidden Road, amazing business, 3 trillion of cleared volume. Last year before last. Incredible business. I come from an equities background. The most profitable bit of equities brokerage for any broker is securities financing, whether obviously in my world, equities historically, equities financing and therein in prime brokerage, but also in stock loan.
Mm-hmm.
So the draw for me was actually being able to face the foundations that underpin altcoin and the main assets that are traded, cross exchange or in spot or in futures markets, etc., regulated or unregulated. But being able to tap into the treasury assets that underpin those tokens or foundations. I'd go with 95% of them are custodied, governed by or owned by entities in Switzerland or Liechtenstein. The vast majority. All of the ones we all know in the crypto market.
Yes.
They're all here.
Mm-hmm.
They were mostly founded here, or at least the foundations that own the assets were founded here. So in the same way that, frankly, the profitability for brokerage businesses and equities is driven by stock loan and securities financing, the same thing should apply here. Maybe I'm a little bit too early, but I saw the opportunity to build a business to start lending token against collateral.
Mm-hmm.
Originally, it began with the notion of lending against US dollar treasuries. You have a mismatch in terms of the liquidation profile of the assets being traded, i.e. borrowed, Bitcoin or otherwise, versus treasuries, which is T+0 versus T+3, or even T+5, depending on who your custodian is. So that didn't work. I was like, okay, right. And I was a bit too early. Now, Bybit proved that there is a market for large wholesale coin borrow, but you can't build a business on a hacking. So myself and my partners, we inverted it.
Yeah.
And it turns out that the dollar borrowing or the dollar equivalent borrowing market against crypto as collateral is enormous. We think it's above 100 billion.
Yeah. Why is that?
I think in essence it comes back to we've got an emergent asset class. I would argue that it has already emerged and it's here to stay. Specifically Bitcoin, Ethereum, Solana, XRP, and maybe the top 10 assets. The ability to borrow against those assets with the assumption being that people believe that there is longevity to them, and I think we can argue that there is, certainly given the widespread adoption, especially in the largest retail investment market in the world, i.e. the United States. You've got what I think one of the pundits this morning was talking about 3.3 trillion in gross assets from value perspective. Let's take a 50% haircut to that.
Okay.
Then let's take another haircut to it. You've got $1 trillion notional of assets which are unlevered in an environment where there is significant concern about the longevity or the viability of traditional assets as collateral. Now, I'm not a doomsday scenario merchant, but we do have a problem in traditional finance from over leverage. Different people will question whether I'm right or I'm wrong. We have a burgeoning debt problem in the developed world. We've been deficit spending for God knows how long. And, I'm an economist by background. Frankly, that's not that important. You've got everything else in the financial markets being used as collateral, whether it be automotive, from my own background as an equity analyst, automotive ABS, being presented to or packaged automotive lending, debt or instruments being presented to the central bank as collateral, to US dollar treasuries, to, frankly, hard currency. All of those assets are leveraged in one way, shape, or form, including our homes, of course. They're packaged up as debt instruments. And yet you've got a T+0 asset that's well in excess of $1 trillion, Bitcoin, sitting on balance sheets or off balance sheet in Switzerland, and which presents an opportunity to provide liquidity, to frankly focus in on that, to provide liquidity so people can invest in other projects. People do not want to sell down their Bitcoin. Sovereign wealth funds are acquiring Bitcoin and custodying it in Switzerland and Liechtenstein. And we're talking about the large sovereign wealth funds, the large institutions, and the large personal pools of wealth, whether they be called family offices or otherwise. They're storing it in this jurisdiction, and it's unlevered. So whenever we see the need for incremental liquidity, whether that's because of a financial crisis Mark II, whether it's frankly from the starting point of the need for incremental investment liquidity, this is the starting point for, I would argue, the next phase of capital markets. T+0, secure settlement cross-border, frankly, the misnomer of financial irregularity. People think about crypto and about stablecoin as a means to simply carry out illicit transactions.
That's correct. That's what people think.
And it's diametrically the opposite of reality. I can see the transactional history of, for example, assets such as Bitcoin. On the other side, from a stablecoin perspective, if I want to transact in that asset, I look backwards to the wallets that it has been through. I can see whether the entities that I'm facing have directly or indirectly been tainted by illicit transactions.
Yeah,
I can't say the same thing from the dollar or the Swiss franc.
I made that case for a long time to people. It's the best way to launder money is still a suitcase full of dollar bills.
Yes.
That's for sure. Although, I mean, you can still do it in crypto as well.
Of course.
But just to get back to what you're saying,
Yes.
so if I understand correctly, and my ability to misunderstand is pretty large, but anyway, let's say if I understand correctly, you're basically saying what you're describing is the initial Bitcoin case writ large, right? That we
Yes.
have a digital asset that's independent, that's basically strong, right?
Finite supply.
Finite supply, so it's deflationary.
Yes.
And
As a store of value.
As a store of value.
Yes.
What about the volatility, though? Is that going away, or I mean?
I'd answer that question. I think it's a very valid question. I'd answer it in a different way.
Okay.
I would ask, where is there not volatility? If we look at the corporate bond market, if we look at, for example, the UK gilts market, we've seen enormous gyrations over the course of the last 3 years, 4 years, 5 years. Outside of the event risk presented by COVID, obviously as an existential crisis, we had a government coming into the United Kingdom under Liz Truss, which saw cable rates, so sterling versus dollar, go from 130 something plus to 103 at one point. And that happened very, very quickly. Now, that's volatility. If I'm holding a, inverted commas, a risk asset, such as digital assets, and they are still a risk asset, we can question whether they are a store of value. If you X out the decline or the erosion of the value of dollar, Bitcoin's actually been relatively stable over recent weeks. Yes, there's been some issues around some of the prognostications and tariff impositions by Trump. I'm not sure if there are tariffs or they're not at the moment.
Nobody is.
But it doesn't really matter. The point is that volatility across financial markets is here to stay. I would argue that it could get appreciably worse, and nothing to do with Donald Trump or Keir Starmer or any of the big G7 economy leaders. I think it has more to do with the burgeoning mountain of debt that has to be funded and or mitigated in some way. And I'll come back to my original point. There is only one unlevered asset out there. It isn't gold, because people borrow against gold all the time. It's no longer national governments, although that's starting to change. But it is this repository of value. And again, I'd point to two different things. One, some of the more thoughtful prognostications from the current US administration, where they are referencing essentially national reserves being partially put into digital assets of various US native form. Not sure whether Bitcoin is actually US native, but they seem to think it is at the moment. That may change. XRP and various other assets.
Ether?
Again, I don't really see how that's a US native asset, but
Yeah.
but the point is that it's the top five. So Solana, BTC, et cetera, et cetera. I think that's almost it's almost a self-fulfilling prophecy. If the largest retail consumer economy on the planet decides that digital assets are a reserve asset, it will become a reserve asset.
Yeah, they come exactly.
And maybe that's part of the point. You know, if I speak to detractors, one of my closest friends is CIO of a very, very large top 3 global asset manager. Until recently, he was referencing Bitcoin as Bitscoins. That has changed. And we've had various debates, often on holiday together. And he said, well, I don't see where the inherent value is. And my answer is, look at the back of the dollar. It says in God we trust. And it is only worth what is being presented in exchange for. So you understand the point I'm making.
What money is what we say it is.
Yes, it is.
That's always been the case. That's for sure. So are you saying then that with adoption, with mainstreaming, with the uptake of digital assets, the volatility will or there's a path for it to decrease?
I don't think all digital assets are created equal. That's kind of a trite comment. But if we're just dialing into, for example, BTC as a repository of value, and we are dialing in on the increased amount of secondary markets that are devolved or derived from it. So, for example, futures markets, perpetual futures markets, derivative markets, as those deepen, volatility will naturally be eroded because it gets essentially competed away by financial market action, free markets. And this is a 24/7 market with enormous volumes. So I think we're still a very small fraction of what we see in other large traded markets, but it doesn't mean that it isn't going to be very important. And I think that's where we have to maybe talk about two different pieces. One, collateral, Bitcoin and other assets, perhaps lesser assets, I would argue. And on the flip side, the massive rise, I think, as one of the Goldman's partners presented it 2 weeks ago at the Goldman's conference in London. It is the age, or it has been potentially the last 12 months, are the age of stablecoin and the emergence thereof. Whether they're backed by gold, whether they're backed by US dollar treasuries, Eurobonds, or sterling, no matter where the denomination occurs from, this is now a competing narrative to that of national currencies. They're obviously inextricably linked to those national currencies because they're denominated in them, and they are backed more often than not by the bonds that underpin the borrowing requirements of those national economies. But it doesn't mean that the impact of blockchain, if we go back to yours and my original sort of pull into this sector, blockchain allows for an increase in the velocity of money, as you and I would think of it. And, therefore the multiplier effect in terms of economic activity is accelerated, for good or bad, by a shorter settlement cycle. That's the really cool thing about the digital asset market. And it isn't about the ICO craze. It isn't about the transgressions of bad actors. There are bad actors in any market. That's why I am in favor of heavy regulation. Switzerland leads the way on that on a global basis. The Singaporeans are following suit and taking leaf out of the Swiss model. Other, MiCA region and UK regulatory impositions are following suit. It's a great thing if we see that kind of regulatory imposition come to bear, so that we can increase the amount of velocity of these types of transactions.
You mentioned a shorter settlement cycle. It's also a safer one, right? It's
Inherently.
it's
Yes, and I can see when
delivery
my...
versus payment, right?
Absolutely. And I think that's the bit that's got me really excited. So if you think about, right, I've got the regulatory regime dialed in. Switzerland and Liechtenstein, essentially, albeit a different sovereign nation, sitting within the Swiss banking rails of 6 SIS and under the auspices of the SNB and FINMA and the FMA in Liechtenstein. So I've got that bit resolved.
Mm-hmm.
I've got a global asset that people want to borrow against and trade in. People think that the traditional markets world, or TradFi, and crypto are distinct. I would argue they're not. They're one and the same.
Okay.
And the regulator here views it as such. I can borrow against Bitcoin and trade in traditional assets from a market perspective. I can present collateral in the form of US government debt and trade in crypto markets. Why can't I do it the other way around? The answer is I can, and I am already if I was a market participant. Certainly here. That impetus will grow. The desire to sweat, in inverted commas, my asset base if I'm a large corporate and I hold treasury in Bitcoin. Bitcoin treasury as an asset class is growing exponentially at the moment. And then how about corporates such as some of the big names, household names that make our, cosmetics and personal items? They are transacting in stablecoin in order to smooth the pathway, not to avoid taxation, because they're big publicly listed companies, but to avoid the friction cost of moving remittances or taking remittances out of Latin America back to mothership in the United States, or frankly, to bypass the United States overall. The friction costs of operating in the dollar zone are legendary. I think it was Franklin Templeton's head of digital asset, Roger Baston. He very aptly put it. It takes me over 5 days to move money, as in dollars, from my Chase account to my JP Morgan account. And yet I can make a transaction of the same size, i.e. large, from my personal account on a ledger to my trading account in USDT or in USDC. And it takes me a fraction of a second. How is that possible? How can that not be used to accelerate the profitability of these big corporates, to reduce friction costs, and frankly, to increase the velocity of money? For better or ill, but we need that kind of systemic change in terms of the speed of transactions in order to deal with some of the problems.
That was certainly the case for blockchain.
Yes.
And when it came out, why don't we talk about the business you're building or have built?
Of course.
The lending business. Tell us about it.
Again, it was derived from, I guess, it was a very large US asset manager that has now actually divested itself of its digital asset business. It was acquired by someone else. That took place about 1.5 years ago. The demand came in to me and some of my colleagues at Hidden Road. Right, I want to borrow $1 billion notional of underlying BTC spot. Can you facilitate it? Well, first off, the institution in question was actually US onshore, and I couldn't face them. But that as an aside, any institution wanting to put up US dollar treasuries as collateral in order to borrow Bitcoin, that will pique your interest when it's $1 billion plus. And of course, this was at what? Sub $50,000 per Bitcoin. Way below. So suddenly that piques the interest. On the flip side, when you go down that route and you suddenly work out, how am I going to do this from a transactional perspective and how do I get regulated to do it? It's a very easy leap to do the inverse, which is dollar lending against coin. To that end, we've set up a series of regulated entities in Liechtenstein, a fund entity in AIFM, which is regulated to lend dollars as the main medium of exchange against crypto custodied at any custodian. So we face assets under tripartite. We have an ACA. We have loan documents that are issued by our second entity, which is a Swiss regulated vehicle. So we lend under Swiss law. That gives me a greater level of enforcement in Switzerland and elsewhere because of reciprocal licensing and recognition of jurisdictional prudence. So I can enforce a loan against an asset custodied at any of the global regulated custodians. I prefer to do it in Switzerland because it's very easy for me to enforce and to liquidate if I have to in whatever unfortunate circumstances. But we now have a scaled, fully tier 1 regulated lending business that can face assets custodied at any regulated custodian. That's incredibly powerful. It's hard to do it. We have all of the margining engines, including at our partners at Haruko. Great guys. Shamil and Noma have built an enviable business that I know Mark from your team knows very well. The demand is there. We have billions of demand in terms of dollar underlying borrowing against no more than 50% loan to value, Bitcoin, Ethereum, Solana, XRP, the top 10 assets, if you will. And again, we will look at staked assets. That just means I drop the LTV.
Mm-hmm.
But the fact that you've got the Swiss and the Liechtenstein regulators willing to prescribe not only the acceptance of a lending business like that, but to do so under very specific guidelines and to do so in the same way that you would be able to offer lending services against traditional securities, tells you everything you need to know about this jurisdiction. It's clear-cut, it's well-defined, and has case law. Obviously, there's a codified legal system here, but there is case law as well to underscore my ability to enforce. And that is what global investors need. So it's no longer this niche business. You have traditional LPs in the alternative asset management world seeking yield on dollars and stablecoin, because I can also take stablecoin as well. They're seeking a mid to high single-digit annualized return for their dollars or their liquidity, and they're very happy to lend against crypto in this jurisdiction because the prescribed level of enforceability is there, and to be able to do so globally. So it's not Seychelles, Mauritius, great places, perfect for going on holiday. Great if I want to mitigate tax. Switzerland's not so good for that, but great if I want to mitigate tax. I can face Cayman, I can face BVI, and we can come on to that as another jurisdictional headache, being able to do this cross-border stuff. But when I've got a tier 1 main regulator and a very stable jurisdiction from a courts and a jurisdictional perspective,
then
it's very different.
Absolutely.
And I think that we will see that kind of pathway and adoption rate take place at the other G7, 8, 20 countries.
That'll get interesting.
Yeah, I think it will very, very soon.
Great. So of course I have to ask you, how does GenTwo fit into all of this? So we've been doing, I think, one product together, another one on the way. Is that right?
Exactly. Yes.
I'd love to understand more about how the relationship came about and what exactly it is we're up to.
So if we take a step back and some of the earlier conversation that we've had around treasury management. So if I'm a big corporate, and this is how the interaction with GenTwo comes about, again, related to Swiss jurisdictional prudence and how that interacts with other regulators. Treasury management is front and center. We've got a global asset class which is quite literally democratized, both in Bitcoin and other main assets, but also in terms of stablecoin. The ability to reliably offer yield enhancement, a much oft used term, I would argue ineffectively, but the ability to offer yield enhancement against Bitcoin and to be able to take subscription for yield generation in stablecoin is only really possible in one jurisdiction. It's here. The ability to, I'm going to use the term democratize again. Your business allows asset managers, smaller ones or larger ones, to be able to democratize the subscription in kind or in just in straight fiat to their business in this jurisdiction and to gain regulatory clarity on an accelerated basis. Now, I guess there are plenty of detractors from those who say building an AMC is just a legal copy-paste. Well, if it were that easy, everyone would do it. And they don't, because it isn't that easy. You have to have the acceptance of the regulators. You've got to have the acceptance from the local banks who act as your conduit for stablecoin, Bitcoin, and also from a fiat introduction perspective. It is very hard to do it. I've known a number of your founders for many years. It's a business that has grown enormously in the last 2 years, I would argue. Some very serious and very traditional investor groups have obviously taken a very close look and like what they saw in terms of the cap table on your side. But I think it's, for example, I'm very closely involved with a business called Danubian, which is a series of very, very smart ex-AWS programmers who almost, I wouldn't say by accident, but coming at the inverted commas problem of yield generation, have devised a series of very stable and off-exchange settled arbitrage algorithms to generate returns in main digital assets. That is actual, stable, reliable, and without going to all of the different metrics that any asset manager will use to advertise their wares, very, very competitive from a global perspective, performance set of metrics. Danubian has developed a risk-adjusted set of returns, which is, frankly, top quintile or better. I'm an advisor to them. The only way in which they could and are taking in local subscriptions here in Switzerland is through GenTwo.
Through the AMC.
Yeah, exactly. The business that optically may look very easy to do, but in fact is very hard to do in practice. And again, it's the interaction with the banks, those much maligned institutions when it comes to crypto maximalists. Without the banks, you can't operate the AMCs in the way in which you need to. And it's the interoperability of what I'm doing from a lending perspective, i.e. dollar lending against coin. The inverse, fine, on one side it's generating yield by lending out the coins. But how about being able to reliably generate returns in the underlying asset?
Mm-hmm.
So I can take subscription in Bitcoin. I can give subscription in traditional fiat or indeed in stablecoin. Banks will be able to accept that. But to be able to do both and to do it in a cohesive manner is why I'm involved in Danubian. It's why I believe in what they're doing. There are a number of other businesses that are involved with you guys that I know incredibly well because my history with Hidden Road, I onboarded a lot of them to the prime broker within Hidden Road. So I guess it's that interoperability, excuse my enunciation, which is important. So if you think about what Bitcoin means and what stablecoin offers, and the same thing with Ethereum and Solana, XRP, all the main board assets, it becomes incredibly important to be able to offer yield generation in those assets. That's what fascinates me.
David, before in the conversation, you said you wanted to get back to talking about some of the other jurisdictions.
Yes, of course.
What's on your mind?
A lot of crypto entities, because of the absence of acceptable or accessible regulation, you guys do a great job of fostering access to the Swiss market regulator, or frankly, from a developed market accessibility standpoint. If you think back 5 years ago, if I think of other great asset management businesses like Tendex, for example, also based here in Zurich, they know you guys very well. It was very, very hard to get acceptance as a digital asset manager or crypto asset manager in most jurisdictions. So the seeking of jurisdictional governance under BVI, under Seychelles, under St. Kitts and Nevis, any and all of the regulatory regimes or the absence of regulatory regimes has seen businesses start up in those jurisdictions. Not just because of malfeasance, although we've seen it. For example, if I am facing a BVI entity and I want to borrow dollars against my Bitcoin, I can do so in BVI. But is there actual acceptance of the asset inviolability in BVI? There's some question marks over that. Same thing in Seychelles. Same things in most of the jurisdictions I've just mentioned. Cayman is a relatively better, non-grey listed, low tax environment, which has traditionally been a feeder jurisdiction for most US hedge funds, for example. It's widely accepted. It's not grey listed by the Swiss and the Liechtensteiners and the Luxembourgers and by everyone else. If one lives by the maxim that not all regulators are created equal, not all jurisdictions are created equal, but ultimately that comes down to the enforceability. Can I rely on the court to enforce against a bargain or a contractual arrangement that I have arranged as either the borrower, the lender, either side of a set of counterparties facing across the table, such as we're at now? I need to be able to believe in the courts. I need to be able to believe in the longevity of taxation arrangements. That's why some of the problems in the United Kingdom are so manifestly difficult to deal with right now, because I don't know what the tax position is going to be 12 months from now. I think you can talk for hours on this, or frankly, you can sum it up as follows. We're looking for clarity. As traditional market investors, we talked about volatility. We want access to the volatility of crypto markets because it's inherently profitable to be able to arbitrage volatile markets. That's great. We want surety, we want fungibility, and we want enforceability. And I would argue that's why I'm here in Switzerland. Switzerland led the way instead of Liechtenstein. They led the way in the traditional market application to commodity trading. So when oil markets were evolving 50 years ago or slightly longer, we obviously had escapees from Fibro that became Mark Rich & Co. that now, of course, is Glencore, Trafigura, Vitol, some of these massive behemoths, often privately owned, not publicly listed, but which control and have an impact on every aspect of the lives that we lead as, developed world or, frankly, any person that interacts with the capitalist world. The same thing applies here. Switzerland, as a very stable location to transact business and to enforce against it, is incredibly important. If you are a digital asset proponent, you should want greater regulation, greater levels of enforceability against contract and tort, and to be able to move the game forwards on that basis. And we're seeing an explosion in the volumes overall of this asset class because the main board regulators are getting around to actually looking at how they enforce and how they tax transactions in this sector.
Well, David, that was really, really interesting. Thank you very, very much. It's nice to get into that level of depth sometimes on the program. And listen, we're glad to have you here in Switzerland.
Glad to be here.
And I wish you all the best. Thanks so much.
Thank you.